Welcome to the webinar, Maximize Your Stock Options to Build Wealth. In this webinar, we will cover 3 topics. The first is going to be the features of stock options and what you need to know and where to find them in the pile of documents you've probably received from the company. Second, we'll talk about taxation of stock options when you exercise and sell them and the common pitfalls to avoid. Then thirdly, we will talk about the strategies to find out how much and when to exercise and sell. I'm Roshni Pandey. I'm a financial advisor at TrueRoot Financial. We help tech professionals achieve financial independence so that you can confidently live your life your way. Now with that, let's begin. The first topic I want to talk about is what are stock options? Stock options give you the right to buy a stock at a certain price called the strike price. Now, the reason why your company's stock options are valuable is for 2 reasons. First of all, they allow you to participate in the growth of the company as time goes on. And then second, they allow you to delay your taxes until you exercise your stock option. Now, secondly, what do you need to know about your stock option? You need to know a few things. First of all, you need to know the grant terms. How many stock options do you have? Are they incentive stock options or are they non-qualified stock options? You also need to know when do they expire. Normally, stock options don't expire for 10 years, but those are things you would have to absolutely know. You also need to know when you vest. Typically, they vest about 25% each year, but nowadays it is changing where a lot of companies are vesting a lot faster. You also need to know, can you exercise before they vest as well? And then what happens to the stock options should you leave the company? Now, in most cases, you are allowed up to 90 days to exercise a stock option should you leave the company. But if you are a key employee of the company and you go work for a competitor, that 90-day might be shortened to, let's say, a month or even 15 days. And if that's the case, you need to know that beforehand. So those are all the things you need to know about your stock options. After that, where do you find that information? There isn't one place where you can find all the information. There are various documents you would need to know. And those documents are, you need to have the stock plan available, the grant agreement, grant notice, and then also have the employment agreement and offer letter ready to make sure that everything jives together. It all makes sense together. Now, there are 2 types of stock options. The first is incentive stock option, and the second is non-qualified stock option. Now, an incentive stock option is typically given by very young companies, often when they're in a seed stage or when they are accepting, round A of funding. That's when companies issue incentive stock options. So they're typically given to early employees. Non-qualified stock options, on the other hand, are given by companies that are a bit more mature. So companies that might be in Series B or Series C funding, those are the kind of companies that typically give out non-qualified stock option. Now, a question I often get is which one is better? Is incentive stock option better than non-qualified stock option? Now, both of them are great, and it's great to have a little bit of both. But if I had to pick, and if I had to pick one, I would say the incentive stock options are better just because of how they're taxed. Incentive stock options are a little bit advantaged in terms of how they're taxed because you only pay capital gains taxes on the exercise and sale of them, unlike a non-qualified stock option where you do pay some income tax. And when you're working for a company, there aren't many opportunities where you can get the compensation come to you as a capital gain rather than an income. So because of that alone, I would say incentive stock options are more attractive. But to the extent you can get both of them, it's great to have some of them. So, it's great to have both of them. The next question, how are they taxed? Now, as I mentioned before, non-qualified stock options and incentive stock options are the 2 types of options, and they're both taxed in different ways. First, let's talk about non-qualified stock options. Non-qualified stock options have 2 different events that trigger the taxes. The first is when you exercise the stock, and the second is when you sell the stock. When you exercise a non-qualified stock option, the difference between the strike price and the fair market value of the stock on the day of exercise is considered to be income. Now, what is strike price? Strike price is the price that's predetermined by your company to be the price where you can buy the stock. And this is something you would get from the grant agreement as well. And the fair market value is basically the price of the stock. So for a public company, it's basically the price that the stock is trading at. And then for a private company, it is what is called a 409A price, which your company should be able to provide. 409A prices are refreshed every year, so you should make sure to get the most recent 409A price from your company. So the difference between the strike price and the fair market value, either the price of the stock or the 409A price on the day of exercise, is considered to be income. So let's take an example. The strike price of a company stock you have is $1, and you sell the stock on a day when the fair market value is $6. Now the difference of $5 is considered to be income, and you pay income taxes on it. How much are income taxes? They can go from anywhere up to 37% in federal taxes, and then you also pay state taxes on top of it. So depending on which bracket you end up in, you will be paying that much for the income portion. So that's the first part. Also, it's important to remember that when you do exercise a stock option, your company will automatically withhold the standard 22% of the income for taxes. So you have to make sure that when you exercise a stock option, you have enough cash to pay both for the exercise as well as the taxes. And if the company is public, your company will allow you to sell enough shares to cover both of those expenses. However, if you don't sell the shares, or if your company is private or you cannot sell the shares, you will have to wire in the money to both pay for the exercise and also to pay for the taxes. So that's the first event that triggers taxes in a non-qualified stock option exercise. The second event that triggers taxes is when you actually sell the stock. And so in the same example, let's say you bought the stock when the fair market value was $6, and then you waited until a year to sell the stock. And at that point, the stock price had gone up to $10. Now the difference of $4, which is $10 minus $6, that difference is considered capital gains, and you pay capital gains taxes on it. Capital gain taxes are typically lesser than income taxes. They go from anywhere between 15 to 23.8% depending on your tax bracket. And if you hold the stock for more than a year, you pay long-term capital gains, which again is 15% to 23.8%. But if you sell the shares faster, sooner than 1 year, then it is considered a short-term capital gain. And so it is just counted as income, and you end up paying income taxes on it. So typically, it's best to sell the shares right after you exercise a non-qualified stock option rather than waiting a year or whatever it is to actually sell the shares. A question I often receive from clients is, should I exercise my non-qualified stock option now and then wait for the stock to go up and sell it a year or 2 years later? And the answer typically is no, for two reasons. First of all, if you don't sell the shares right away, you will have to come up with cash to pay for the exercise and the taxes. And it can be a lot of cash that you need to come up with. Secondly, the stock can go up, but it can also go down. So that's really important to remember. And if the stock does end up going down, you just paid income taxes on a stock that ended up with a loss, which is a really bad outcome, which we want to avoid. Another variation of the same question I get is, when the market is volatile and the stock is down a lot, clients will ask me, should I sell the stock now and take the lower income tax and then keep the stock and take capital gains as the stock price goes up? And the answer is, maybe in theory, if everything works out perfectly, but in practice, generally no, because when you add more cash to pay for taxes and to pay for the exercise, you're concentrating yourself even more in that one stock. And the stock might come up, but it might not ever come up. It might actually go down or just stay where it is. So the best strategy is to exercise and sell the stock right away, and then to use those proceeds in a diversified portfolio. And if you really believe in your company's stock, you really believe it's going to come up, just buy some of the stock in the public market and keep it as a part of that diversified portfolio. So that was non-qualified stock option exercise taxation. Now let's look into incentive stock option exercise and sale. Incentive stock options have a built-in tax advantage where if you meet two conditions when you exercise and sell the stock, the whole gain that you make from the exercise and sale is considered capital gains instead of income, and hence you pay a lower capital gains tax instead of the higher income tax. Now, what are those two conditions? The two conditions are first, that you sell the stock 2 years after grant date, and second, you sell the stock 1 year after exercise date. So 2 years after grant date and 1 year after exercise date. And both of these conditions have to be met in order to achieve that tax advantage. And the tax advantage is called a qualifying disposition, meaning that if you meet these two conditions, then your stock option is considered to qualify for the disposition that gives you the tax advantage. Now let's illustrate this with an example. In the same example as we discussed before, let's say that your strike price is $1 and you exercise the option on the date that the fair market value is $6. Now you have a gain of $5 that is considered capital gain, and you do not have to pay any taxes on it at exercise. Also, no taxes are withheld by your company at exercise because this is an incentive stock option. Now, when you sell the option a year later, meaning that you beat both of those conditions, when you sell the option a year later, let's say you sell it at a price of $10, that gain again of $10 minus the fair market value on the exercise date of $6, the difference of $4 is also considered capital gain. And so as a result of that, you pay capital gains on the full $9, the $4 from the sale, and the $5 from the exercise as capital gain taxes, long-term capital gain taxes, and no income taxes at all. Again, there is no taxes withheld when it comes to incentive stock options by your company, so it's really important that you have enough cash on hand to pay taxes next April 15. And if you need to make any estimated payments, you also have to make that this year. However, what complicates incentive stock option exercise is the alternative minimum tax, AMT. What is AMT? AMT is part of the tax code that the IRS came up with in order to make sure that a lot of wealthy taxpayers were not underpaying their taxes. So what happens is when you exercise your stock option and you hold it past December 31st of the year, the gain that you make from exercising the stock option is considered to be AMT income. And if that income is higher than your normal income taxes, you end up paying the AMT income tax. So in our example above, when the strike price is $1 and you exercise the stock when the fair market value is $6, the $5 income is used to calculate the AMT taxes if you hold the stock past December 31st. And if it turns out that the AMT income taxes are higher than your normal income taxes, you actually end up paying AMT tax instead. Again, AMT is triggered only if you hold the stock past December 31st. And again, this is a big wrinkle because in order to meet those two conditions for a qualifying disposition, which is 2 years from grant date and 1 year from exercise date, you have to hold it past December 31st. You cannot sell it before December 31st. But once you hold the stock past December 31st, AMT might be triggered. So as a result of this, before you exercise incentive stock options, you have to be sure to know all your tax implications. What are the capital gains? What are the AMT? You have to know all of this before you exercise a stock option. And this is where working with an advisor can be super helpful. Now, if you don't meet those two conditions, 2 years from grant date and 1 year from exercise date, then you are left with what is called a disqualifying disposition of your incentive stock option. Now, what is a disqualifying disposition? A disqualifying disposition is where you exercise and sell your incentive stock option and you're taxed on it like it was a non-qualified stock option. So let's go back to the previous example where the strike price was $1 and you exercised the option when the fair market value was $6. Now, the difference of $5 in this case would be considered income and you will pay income tax on it. And then when you sell the stock, you will again pay capital gain tax on the difference between the fair market value of the stock on the exercise date and the date that you sell the stock. So in this way, when you have a disqualifying disposition, your incentive stock option is taxed like a non-qualified stock option. However, it's important to remember that in an incentive stock option, your company will not have withheld any money for taxes at all. So it's up to you to make any estimated tax payments as well as to keep enough cash on hand for the tax payments next April. Because of all of these issues, when it comes to incentive stock option, we advise clients to exercise earlier in the year so that if the stock price goes down, we can sell the stock before December 31st so that the client doesn't incur any AMT taxes. Now that was option taxes. Now let's discuss how much and when to sell. How much and when to sell depends on two broad set of factors. The first is personal factors, and the second is company-specific factors. When it comes to personal factors, it's things like, what are your personal goals? Do you want to buy a house? Do you want to save and invest for your children's education? A lot of our clients want to retire early, make work optional. So if that's the case, how much money will you need when to support your lifestyle? It could also be that you are leaving the company, so you need to exercise and sell the stock sooner than you were planning to previously. You could also be too concentrated in the stock. Normally, you shouldn't have more than 25% of your net worth in your company stock. So if you have more than 25%, it's also a good time to diversify some of that as well. So those are the personal factors. And remember, doing a financial plan is really important for you to understand how much money will you really need and when, the timeline of that. All of that comes up when you do the financial plan. Second, stock-specific factors. First of all, when it comes to non-qualified stock option, you should exercise the stock option when it's deep in the money. Now, what does that mean? Deep in the money means that there is a big difference between the strike price and the fair market value of the stock, where you stand to profit a lot from exercising the stock option. Now, you might believe that the stock option will go up a lot and you might want to hold on to the option. However, there is also risks associated with that because the price could also come down and you could lose the opportunity. So this is a classic risk management exercise where having an advisor can really help you make those key decisions of how much to exercise and when. For non-qualified stock option, it's best to sell the shares right after you exercise them. For incentive stock option, on the other hand, the best time to exercise it is when the strike price is closest to the fair market value of the stock. This ensures that you have the least amount of AMT taxes, and even if you trigger AMT, it's going to be very little. Also, you can participate in the upside of the company as the stock price goes up, and if you hold it for longer than a year, you also have a qualifying disposition, so you also end up paying less taxes. Now, if you work for a private company, holding the stock for a year might be a risky strategy because the company might never have an exit. This is where we help our clients decide how much to keep in a qualifying disposition and how much to keep in a disqualifying disposition in order to minimize risk and also minimize taxes. If you have lots of incentive stock options, you will also need to spread the exercise and sale across multiple years in order to keep your taxes low. Again, this is something that we help our clients with to design the multi-year exercise and sale plan of incentive stock options. Now, once you have a strategy for how much and when to exercise, the next step is to invest the proceeds right away. Make sure to keep enough cash for paying your taxes, either your estimated taxes or your taxes next year in April 15, and then with the rest of the proceeds, invest it right away so you participate in the market upside. That brings us to the end of the webinar. I hope that was useful. If you have any questions, please let me know. If you'd like to know more about our services and how we work with our clients, please go to our website, www.truewoodfinancial.com, and book a call with me there. Thank you.